How does a company respond when its core business shows signs of slowing down? Do they panic and pull back, or do they see an opportunity where others see risk? That's the question we're asking today about Bread Financial and their surprisingly calm reaction to a dip in credit sales. In their recent earnings report, Bread Financial acknowledged a trend that's got a lot of people scratching their heads: a slowdown in credit sales. Now, for a financial company that thrives on consumer spending, you'd think this would be a major red flag. But instead of sounding the alarms, the company seems to be shrugging it off. Why? The answer lies in two key areas: the quality of their credit card portfolios and their long-term strategy. Think of a credit card portfolio like a garden. You can have a lot of plants, but if they're not healthy, they're going to cause problems down the line. Bread Financial, it seems, has been cultivating a very healthy garden. They've been focusing on building a high-quality portfolio of cardholders, which means they're lending to people who are more likely to pay back their debts. This is a crucial distinction. A drop in sales from less creditworthy customers isn't as big a deal as a drop from your most reliable ones. So, while the overall number might be down, the health of their core business remains strong. This strategy isn't just about avoiding risk, it's about setting themselves up for long-term growth. When you lend to a more stable customer base, you reduce the risk of defaults and charge-offs. In simpler terms, you're less likely to lose money when the economy takes a turn for the worse. Bread Financial is essentially building a fortress against future economic uncertainty. The company is also leaning into their other revenue streams to compensate for the softness in credit sales. This is where their strategy gets even more interesting. They're not a one-trick pony. They're heavily invested in loyalty programs and co-branded credit cards with major retailers. This means a portion of their income isn't directly tied to how much people are swiping their cards. It's tied to brand partnerships and the value they bring to their retail partners. This diversification is a major reason why they can afford to be so calm. They have other engines driving the car forward, so a slight hiccup with one engine isn't going to bring everything to a halt. It's a classic case of seeing the forest for the trees. While a short-term drop in sales might look bad on paper, Bread Financial is focused on the bigger picture: a stronger, more resilient business. They're prioritizing quality over quantity, and it's a strategy that seems to be paying off. They're betting that a robust portfolio of customers and diverse revenue streams will put them in a better position to weather any economic storms on the horizon. This long-term thinking is a stark contrast to companies that are chasing every last sale, regardless of the risk involved. So, while the headlines might suggest trouble, a closer look reveals a company that is being smart and strategic. They're not brushing off softer credit sales. They're confidently navigating them with a plan that's focused on sustainability and strength. They're playing the long game, and it's a game they seem to be winning. With that said, thanks for watching, and until next time.